Okay, this is the last video in our course on reading financials, and then this one we'll do a little bit of formatting. And what we will do is, if I can get here, is we'll do a little bit of financial ratios just to set up our assumptions. What kind of reasonable assumptions could we make? It's not a very dramatic kind of company here because there's not much volatility, I think, in revenues. And how could we do some little valuation analysis, PE ratios, EV to EBITDA ratios, market to book ratios? Now they did a lot of this, so let's set something up a little bit here. Okay, first of all, I don't want this, and then let's, it's not bad to put some titles in here. Shift Control E, that's just from the generic macros. Shift Control E, okay. Shift Control E, and if we were a little bit more careful, we might even check the fact that the balance sheets balance, okay. And total non-current liabilities. Total current liabilities and total liabilities. Just pressing Shift Control R twice, and then we'll put the income statement, profit and loss. Okay, and well, I think how does it happen if we do it like this? Let's do this. I'm gonna put our balance sheet in. I'm gonna copy it here, and over here I'm just gonna put a dot, nothing more than a dot. And then over here I'll put a dot. Oops, a dot. And then put profit and loss. Okay, and then we'll put another dot over here somewhere. See, I can't even find it, diluted. Here's our statement of cash flows, a dot, and put statement of cash flow. And then let's put a summary page, okay? I don't really have to bold that, I don't think. I'll show you why in just a minute. And so there we have, okay. Perhaps Shift Control, Shift space bar, Shift Control plus, and we'll put summary. Okay, and then the real objective of this last video is they have some financial ratios computed already, but I think we should compute our own financial ratios. Now, I'm going to kind of do something tricky. I'm going to add it here. The reason I added it here is that then when we make these things will go down to the end of the financial ratios. So what we're going to do is redo kind of some of the financial ratios. Or let's put ratios for operating assumptions, and let's then put some ratios for financial analysis. Now, I'm gonna go, and I'm not gonna waste more time with the underlining, but if you go to the generic macros file, and we're going to use this for the title and for the color input. Let's put a flexible color input, which means, I don't really want to color the inputs. I haven't even tried this. I don't think I've even done this. This probably won't work, but if we press Shift Control C, well, the flex color thing I haven't changed yet. So it's kind of a mess with all these colors, but you know, the main thing I wanted to show you is you can just put a dot so we can see where all our financial statements are. Okay, and now for the ratios for our financial analysis, for our operating assumptions, the very first thing is I think we should figure out what the EBITDA is. And then we can say our COGS. Now let's look at our cost of goods sold. And when we look at our cost of goods sold, we have revenues, and you see that there is no depreciation expense. Now, if you got really fancy, you'd look at the notes and see how much depreciation, how much of the depreciation was allocated to the cost of goods sold. I'm not going to bother with that, okay? And there's some adjustments for impairment losses, and we should figure out really what kind of things we need to do in order to get the EBITDA and get the cost of, let's put cost of goods sold, and let's put less depreciation expense. And then we can put COGS margin. Okay. If we we put COGS without depreciation, and we can put COGS margin. And let's just get a nice little trend in that one. And all of these you realize will be on the thing. And then we might want to get our EBITDA margin. And we'd really want to make absolutely sure that the forecast is consistent with the history. When we compute our EBITDA, by the way, we'll get into this kind of debate about whether to include the associated profits from the associates. Okay. Let's make a couple of more ratios. Okay, and let's maybe put our SG&A expense and our admin expense. Let's look at that. Let's look at the SG&A and admin. Okay. And get the SG&A as percent of sales. And you know, the last video suggested there's some fixed cost. Remember what we had done here. Let's go up and find the net revenue. And when we compare the net revenue to the admin expenses, we have I was wrong. The net revenue to the sales and distribution expenses. And I'm doing it backwards. Excuse me, I better fix that. Net revenue on the x-axis, and on the y-axis we put sales and distribution. Since this intercept is a positive number, you could kind of say, when the sales go up, it's not one for one. If this crosses the zero axis, then you can say, it's one for one. We could try to put in some sort of fixed cost, okay, if we got really fancy. All right. Then let's put our depreciation rate. And how about we'll put a tax rate. Okay, and once we have, so that some of those, now we can also put some, I think that gets a lot of the kind of stuff you might look at on the income statement. Perhaps we should also we could look at the growth rate in sales. We've already looked at that really on the graph. Okay. We might want to compute the average interest expense and average interest income rate. How's that? Okay. And we might even finally want to look at all of those associated investments. Okay. Where our share of profit from after tax from the associates. All right, and we can compare that to the amount on the balance sheet of the investment in associates. So let's get return on associate, return from associates. Okay, and then we can also start with the balance sheet. I'm going to put some balance sheet things like the accounts receivable to sales and all of that. All right, then we'll get some of all that stuff. Now, once we have that, let's get the NOPAT, which is the EBIT times 1 minus the tax rate. Okay, and we'll have to decide whether we want to include the associates or not. And then once we have that, let's get the invested capital. And the invested capital, we have to pick out and decide which things on the balance sheet we really want to include in the invested capital. Now, this company computed invested capital for us. Okay, and we're going to compare the invested capital that they computed with kind of what we might compute. Okay, and then we can get ROIC. All right, and let's see what there. And why don't we also put equity capital without minority interest and get the ROE. I don't know why they didn't get the ROE. And then we actually have the interest expense and all that. So we can see where they're kind of what their return is. And the other thing is they have the stock price up here. Okay. And I think the first thing we should do is get the market capital. And then our capitalization, I can spell it right. And then once we have the market capitalization, we can get the PE ratio from TTM, trailing 12 months, the last 12 months. And then we can get the PE ratio from the forward. And see kind of what's happened to the PE ratio. We can also add the net debt. We can compute the net debt then and get the enterprise value. And then once we have the net debt and the enterprise value, we can compute the EV to EBITDA ratio. Okay. We can also, I suppose, look at EV to EBIT. Okay. Now what I'm going to do is I'm going to put this on the website, and I'm not going to record the video while I'm typing some of the ratios, and I'll probably include 1 or 2 more ratios, but I just want you to kind of get a general idea on some of the things you might want to compute. I would also put a price to book ratio and even an EV to invested capital ratio. And this one I think is so crucial because it shows you if you're earning more than your cost of capital. That's what it really is. I can kind of show you. when we do the ROIC, there'll be a number of issues, and I'm going to turn off the video right now or pause it, and then we'll come back and discuss some of these things. Okay, so I'm back after, frankly, a long time. Here's the first thing I did to compute the ratios. The first thing I did, and the first thing I think is a good little suggestion, is to go to the side of the balance sheet and classify every single asset and liability as either being, except the totals, as either related to financing or related to making EBITDA. Okay, and if it's related to making EBITDA and it's an asset, you put +1, so things like property, and definitely goodwill, and definitely receivables, and all those are all related to making EBITDA, and then things like accounts payable and all that, and even deferred taxes are related to the fundamental business. And then you have the financing of the business, and things like cash, securities. I also put assets held for resale because they're not related to EBITDA, they're below EBITDA. And then equity and even pension obligations, these are all related to financing the business. Then you can also have a similar little plus or minus for net debt. It's just like a little true false. And then you can compute invested capital by taking its sum product of all of the items on the balance sheet multiplied by these little ones. Or you can do the same thing, sum product, and take it by the second little ones. Okay, and you can do the same thing with the net debt. It's the sum product of everything that you have a little flag for, a little switch, 1 or -1. If it's net debt, if it's cash, it's a -1, and if it's regular old debt, it's a +1. So that's the first step. Then we have our profit and loss and our cash flow statement. Now on the cash flow statement, there was something kind of interesting. They started with operating profit before special items. So they're kind of saying this is the profit you would normally make. And then they add back depreciation and amortization. And then they even add back the impairment losses. And then they get to operating profit before depreciation and amortization and impairment. And that looks a whole heck of a lot like EBITDA. That looks a whole heck of a lot like EBITDA. And then they have some adjustment for other non-cash items. They don't really describe what those are. They have some change in working capital and other working capital and interest paid and interest received. And then they have this item called restructuring costs paid. This is clearly intended to be not EBITDA, but look, it happens every single year. Is this not a kind of recurring cost? If it was only one time, I wouldn't make an adjustment for EBITDA to take it away. But I think it is, and there would probably be another question around this one, whether this one, EBITDA, should be reduced for this one. And let me see, it's not an enormous item, but it's, I mean, if you compare it, it's something, okay? And then they have the rest of the CapEx and all of that. Okay, and then we, of course, have our summary sheet. And we're ready to go. Now, here's the interesting part. When they compute return on invested capital, they do it without goodwill. I don't know why you would do that, really. Goodwill you made an investment for. How could you not call the investment you made in goodwill invested capital? Otherwise, you're just throwing away the money, so they made an adjustment for it without. And then they say if we take goodwill out, then we're earning about 14-15% on the amount you invested without counting the investment you made to buy the company. Now, with invested capital, they get 8%. Just to take a peek, when we did it, I did it, you and me, you can test me. Maybe it's partly because of these restructuring items, but I get a return on invested capital that's quite a bit lower. Okay, and let's look at, so here's our uh, EBITDA calculations. I'm pressing Shift Control 1. I want to press Shift Control D, but I can't do that. Okay, I can press Shift Control N, I guess. And then we can take our revenues minus our cost of goods sold, and we can get all of our cost of goods sold margin. Now, if you're making a forecast, good news here is you kind of have a history. So if we wanted to graph our, where's our cost of goods sold margin, I would definitely want to show this. That's EBITDA, the cost of good margin, has been hovering in a pretty tight range. You probably, I'm not going to go get all obsessed about making a scale, but you could see that if you made an assumption very different than that, that would be kind of a crazy assumption. We could look then at the EBITDA margin as well. Okay, so that's just the EBITDA divided by the revenues. That's kind of had it not quite as stable as a pattern. Maybe partly there because the selling SG&A expense has gone down a little as percent of EBITDA, and admin has kind of gone up and down. So you can make your little adjustments there, and then we can get our plant and equipment and all that, and we can then look eventually at the return on invested capital. Okay. Okay, and for the depreciation rate computed an average, it's interesting how the depreciation rate went up. Now they had some kind of write-off. I'm not sure if it was impairment of assets or goodwill. So the plant went down, and as the plant went down, notice the gross investment went down, and if you're making a high level of capex, this is the capex they're spending. Okay, let's Shift Control N maybe. The capex is when their capex is greater than the depreciation, then you'd expect the depreciation rate to go down. Here it went down, and then it went up as the okay. This one clearly went up, but I would expect as you make lower capex, it goes down. And then we just can take the tax rate divided by the pre-tax income, and we can get some accounting, kind of accounts receivable, accounts payable things. Okay, let's do accounts receivable to sales. Okay, we can kind of get a nice little, that's just the total amount as a percentage of sales. So you can use this to make some kind of forecast. Okay, then you can next get the EBITDA, EBIT, which is the EBITDA minus the inflation depreciation rate, and get the NOPAT, which is the EBITDA, and you'd subtract the tax rate. And I made an adjustment. If the tax rate was negative, I kept it flat. Otherwise, I used the regular tax rate. You can argue, well, maybe we should have used a different tax rate. I don't think so. And then we can get the invested capital. I talked about that just a couple of minutes ago. That's from in the balance sheet adjustments, and then we take the NOPAT divided by the invested capital, and we get our return on invested capital. And then I like to compare that to the return on equity. Some people can get into a big argument about which is the best ratio to look at. I'm not going to argue about that right now, but you can kind of see what's going on. The return on equity is a little bit higher than the return on invested capital. They've got some minority interest, and we can do the same thing. We can take the amount from the balance sheet and the amount from the income statement and see what kind of return they're making. That's interesting. They're making a better return than the regular old shareholders. Then we can see what kind of interest rate we're paying. I'd ask, why is this interest rate kind of seems a little bit high to me? Maybe they're paying some fees and other things. So then we're getting kind of to what the weighted average cost of capital is. This interest rate, they seem to be making a pretty good return on their cash investments, almost as good as their return on invested capital. And then we can even compute the income from associates. So you can compute this whole series of returns. Finally, they gave in the summary page, they gave the share price. Now, I assume the share price was for the common shares, okay? And hang on, I just realized I should have multiplied the share price times, perhaps we should have used this one down here, excluding the treasury shares, okay? And then we can get the enterprise value by adding the debt to it. Now, one of the most interesting ratios really to me is this one. It's the price to the book ratio, which you can say it's gone up and down, but in these 3 years, and perhaps this year, it went way up. But in these 3 years, we can compare. If this market to book ratio is greater than 1, you can, and especially with a stable company like this, you could reliably kind of say that this return on equity, especially the last one, this return on equity is greater than the cost of equity. So we don't know exactly what the cost of equity is, but it should be substantially below 8%. You can do the same thing with the enterprise value. Where's the EV to the enterprise value? Right here. Now that's just closer to 1, suggesting that their return on invested capital is similar to the cost of capital. It's not an exact thing or anything else, but it should be pretty close. Okay, so that's the kind of analysis you can do, and that's why we downloaded all the files. Okay, and we made a graph, and I think that's enough. Okay, it wasn't that long. I was afraid of the length. It's